Stock market's down 15%. Your friend texts, "Now's the time to buy." 3 days later, it's down another 8%. Should you have waited? A week later, it's up 12%. Did you miss it? Most people never invest because they're stuck in this loop forever. Dollar cost averaging exists because markets move and humans guess. In the early 1900s, when regular people started buying stocks through payroll plans, investment firms noticed something strange. Workers who automatically bought shares every payday often beat investors who carefully studied charts and waited for the right moment. The automatic buyers weren't smarter. They just removed one impossible decision from the equation: which day to press the button. Dollar cost averaging, usually called DCA, means splitting your total investment amount into smaller chunks and buying at regular intervals regardless of price. Instead of investing $5,000 on one specific Tuesday, you invest $500 on the first of every month for 10 months. Same total money. Completely different exposure to price swings. The core idea is mathematical, not magical. When you buy the same dollar amount repeatedly, you automatically buy more shares when prices are low and fewer shares when prices are high. Say you invest $200 monthly in a fund. In January, the share price is $20, so you get 10 shares. In February, it drops to $10 per share, so your $200 buys 20 shares. In March, it's back to $20, you get 10 shares again. You spent $600 total and own 40 shares. Your average cost per share is $15, even though the price was $20 2 out of 3 months. That's the averaging effect. Your dollars bought more units when things were cheaper. Compare that to lump sum investing, where you invest your full amount immediately on one day. If you put $600 in during January at $20 per share, you own 30 shares. When the price drops to $10 in February, you're sitting there watching, already fully invested. When it recovers to $20 in March, you still only have 30 shares. The lump sum investor has $600 in and 30 shares. The DCA investor has $600 in and 40 shares. Same money, different outcomes because the timing was spread out. Here's the critical part. This is not about DCA being better than lump sum investing. Over long periods, lump sum usually wins because markets generally trend upward. If you have $600 today and immediately invest it, that money starts working in the market today. The DCA investor keeps $400 sitting in cash for 2 months, missing any gains during that time. Historically, markets go up more often than down. Lump sum captures those ups earlier. So why does DCA exist if it's mathematically likely to underperform? Because investing isn't just math. It's psychology. The biggest risk isn't slightly lower returns. It's never starting at all. Imagine you inherit $12,000 in March of 2020. The market just crashed 30% in 3 weeks due to pandemic panic. Do you invest all $12,000 right now? What if it crashes another 30% next month? Most people freeze. They wait for a clearer signal. They're still waiting in July when the markets recovered. Now it feels expensive. They wait for the next dip. It keeps climbing. By December, they've spent 9 months researching instead of investing, and the window closed. DCA removes that paralysis. You invest $2,000 immediately and set up 5 more automatic $2,000 purchases over the next 5 months. If it crashes further, your future purchases get more shares. If it recovers, you're already partially in. Either way, you're actually investing instead of spectating. The second psychological benefit is reducing regret. Lump sum investors who buy right before a 20% drop feel catastrophic regret. They see their account down immediately and often panic sell, locking in losses. DCA investors who buy before a drop shrug it off because they know they're buying more next month at better prices. The pain is diluted. Same loss on paper, totally different emotional response. Now the misconceptions. First, DCA is not a way to beat the market or earn higher returns. It's a way to manage entry risk and emotional tolerance. If your only goal is maximum returns and you can stomach volatility, lump sum wins most of the time. Second, DCA doesn't protect you from losses. If you dollar cost average into something that keeps falling and never recovers, you're just throwing good money after bad in installments. DCA smooths your entry price. It doesn't fix bad investment choices. Third, people confuse DCA with simply adding money regularly to investments over time. If you invest 10% of every paycheck into your retirement account for 30 years, that's disciplined saving. That's good. But it's not DCA in the strategic sense. DCA specifically refers to splitting a lump sum you already have into smaller time-based purchases. The paycheck investor doesn't have a choice about timing. The DCA investor does and chooses to spread it deliberately. Here's where the simple story breaks. DCA works best in volatile, sideways, or declining markets where prices bounce around. In those conditions, your later purchases genuinely average down your cost. But in steadily rising markets, every delayed purchase costs you. You're buying fewer shares at higher prices each time. If a stock goes from $50 to $60 to $70 over 3 months, and you DCA 3 equal payments, your average cost is $60. If you'd invested everything at $50, you'd own more shares at a lower cost. The math gets messier with transaction fees. If you're buying individual stocks or funds with purchase fees, making 10 small buys costs more than 1 large buy. Those fees eat into returns. DCA makes most sense with zero commission brokers or funds that don't charge transaction fees. Time horizon matters enormously. DCA over 3 months barely affects long-term investors. DCA over 2 years significantly delays market exposure. Most research suggests if you're spreading a lump sum via DCA, do it over 6 to 12 months maximum. Longer than that, and you're just keeping money in cash, which has its own costs. There's also sequence risk. If your DCA period happens to perfectly align with a market that only goes up, you underperform dramatically. If it aligns with a crash followed by recovery, you look brilliant. But you don't control which scenario you get. That's the whole problem DCA tries to solve, and it's also DCA's limitation. You're still exposed to whatever happens during your chosen timeline. Dollar cost averaging is a technique for splitting a lump sum investment into smaller, time-based purchases to smooth out the price you pay per share. It exists because timing markets is nearly impossible, and attempting it causes people to never invest at all. It doesn't maximize returns, but it minimizes the pain of buying right before a crash and the paralysis of trying to pick the perfect entry day. The math usually favors lump sum investing. The psychology often favors spreading it out. It's a trade-off between potential performance and actual participation.